Okay, welcome everyone. We'll start lesson 3. Today lesson will go through LO3 learning outcome 3. As you know me, my name is Anjum Sattar. If you have any question, please drop me email anjum@ukversity.co.uk. And today lesson will be LO3 be able to perform effective capital expenditure appraisal using the range of technique. Capital expenditure is known as a long-term expenditure, such as if you extending your house, which increase the value of the house, that will be clustered as a capital expenditure. If you're buying a car, it's not a revenue expense, it's a capital expense because it's your asset. That will be your capital expenditure. If you doing the service of your car, that will be your revenue expenses, which is normally the low value expenses. That revenue, and the capital is a high value. Okay, so today lesson will be long-term non-current asset, short-term working capital. We'll discuss, so non-current asset being the asset which we can use number of years, such as property, plant, equipment. Those are long-term assets. Short-term asset which we can use less than a year, or their values carry on changing, like the inventory, stock, prepaid, anything you paid advance, and cash. These are short-term and their values carry on. So working capital is known as the running capital, like such as inventory turnover days, receivable turnover days, and minus your trade payable turnover days, how many we have, how much. Yes, so that will be difference is known as a working capital cycle. That will be, and we'll go through the sources of funds. Okay, so always good to be when you start any activity, just reflect what you know already about investment appraisal. So we doing investment appraisal, so always good to be look around what you know already about investment appraisal. Okay, so please, that's we need to look around today lesson, which we'll go through. Okay, so let's please. Okay, so scale 1 to 10, how much you know about investment appraisal? Okay, so first thing today we'll discuss about appraise the various short-term and long-term, the sources of finance, where we can borrow the money. Second, we look around, critically examine the key factors affecting the choice of sources of finance. That will be in our discussion as well. Okay, guys, so give me just 2 minutes, please. Can we look? Yes. Okay, welcome everyone. We'll start. So as we discussed earlier, today lesson will go through appraisal and sources of finance, which I explained you today. 3.1, we have appraised the various sources of short-term, long-term, critically examine the factor that are affecting the choices of the sources of fund, determine how much money is needed by the company, prove to your investor that's the company required predetermined amount of money, which we use Campari in a minute, and which is, we'll discuss the abbreviation of the words. First is the character, abilities, margin, purpose, amount, repay, and insurance. So Campari is look around the characters, look around the ability, look around the margin, look around the purpose, look around how much amount, how much will be paid, and what insurance we have. Offer incentives, yes, interest are collateral for investors, and contribution. That's which we need to be make arrangement to pay the loan. Okay, so to video enhance your understanding, so please different sources of finance and why sources of finance is a crucial. So at the moment, national in the UK base rate, which is called basic interest rate, which is 4.5%, plus bank also charge the cost, which is 2-3%. So we'll get the interest rate around 6-7%. So you need to be calculate how much you're buying, when you need it actual money, and for how long you need all these. You need to be Campari, which we said earlier, need to be make sure. Welcome. Okay, and can you hear me now? I was muted before I not checked. I was paused meeting. Okay, can you hear me? Okay, hope so you can hear me now.
Yes, I can.
Okay, thank you. Thanks for joining. Okay, character of borrower. Yes, so look around ability to borrow, how much money they have. So we do the credit check. Credit check. Credit check means checking the ability somebody is affordable, because it's a crime in UK to lend money someone which don't have ability to pay you back. Margin of profit, how much banker will want the margin of the profit, which is like 4.5% is the basic interest rate, which set by the Central Bank of England. This went up 0.01% to 4.5%, which is a huge increase. That's why mortgage, everything went up. So purpose of the loan, why you want to be, is it for study loan, or you want to buy a car to borrow money? Amount of the loan and interest, how much will be, and repayment term, how often you have to, how long will take you, and insurance in case, if you can't afford it, what will be happen. So we can PPI, payment protection insurance, we can buy, and that's, which is crucial. External source of finance, we'll discuss, these are external bank loan, additional partners. If it's a business, is a partnership, you can include more partners and join your business, and that will be increase your money. Share issues. Yes, if it's a company, we can issue shares, and especially public limited company. Leasing, we can lease them, like various assets. A car can be leased. Hire purchase agreement, like a rent. Mortgage is a long-term borrowing, and trade creditors can be more than a year. So talk in the pair, of course, we have just few people, but you can, in your time, it's good to look around what research your sources of finance and answer the following question: what it is, how it's used to business. Yes, advantages and different advantages of sources of finance: short term, long term, medium term. So short term can be overdraft. Overdraft can be, and then you can prepare your flip chart and things, because of course we are delivering online, and so please, you can create your own, and we can discuss in the next class. Okay, so external sources of finance, which is bank loan. This money is borrowed at agreed rate of interest over the set period of time. Set repayments over the period of time, and disadvantages can be interest is involved. If you can't afford it, it can be liquidate, it can be more expensive, and bank required the security. That's, which is crucial. Overdraft is also external, but is a short period of time, normally for 30 days, 90 days, and the bank carry on reviewing the overdraft facility. This can be taken out. Normally interest rate can be high if not been arranged, and this is the good ways to cover your period between the money going out or money coming. Sometime your salary will come at the 30th and or the first of the month, and in between on the 20th you're out of the money, and that overdraft you can use, and when money will come, automatically will be paid off. Interest rate repayable on the overdraft facilities amount overdrawn, and can be expensive to use in the large amount. That's we have a problem. Any question? If you have, please carry on asking. Borrowing from the bank, type of bank in the banking system. Uh, Type of banks, so we need to look around different bank, clearing banks, retail bank, merchant banks can be, and this provide the payment mechanism and the payment, and provide a place to store, and the people and individual are the firms. The wealth and the lending money in the form of loans or overdraft, acting as a financial intermediaries, and provide, the customer with the means to obtain the foreign currency or selling the foreign currency. Yeah? Okay, bank will lend you money only if they will be repaid within the reasonable time. They will make, more themselves by lending it to you and making you pay interest. Then they would be from doing something else with their money. Okay, so additional partners can be, as we mentioned earlier, doesn't have the repaid, no interest, disadvantage. Your profit need to be spread into the many people. Dilute, control, and the additional partners. Okay, share. as shares normally companies issue, we have a repay period and profit will be paid out as a dividend. So that's which we need to look around. Any question? Okay. So that's we can do a bit research about shares and types of shares. Okay. Can we spend 5 minutes? If you do Google it, do research types of shares and Unilever share price. Unilever, which is the company, Unilever share price, please. Can we spend 5 minutes? If you Google it, yes, types of shares and Unilever share price. Okay, and then we'll do the next bit, please. Spend 5 minutes. 5 minutes activity, please.
Can you give me a second? Can you repeat
So
what I had read?
in the chat, I just mentioned, do the research about types of shares. Yes. How many types of shares we can issue? Yes. If you Google it, different types of shares. Yes. And also look, Unilever share price. How much is it? Just Google it. Okay. Can you? Yes. Spend 5 minutes, please. Whatever you can find.
Okay.
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 Yes, we found something. Yes. So just 1 second, I can share with you. Okay, so here we can look around. Major 2 categories we can say, in this way. So preference share, preference where we give the fixed dividend, preference share. They don't have voting rights. So no voting right, those shareholders, because normally shareholders have a voting right. Sale share mean the small proportion of the investment for the company. Piece of paper they issue, they can be secure. Yes, no voting rights. Fixed dividend. Dividend mean return on their investment. Like like we do if you borrow money from the bank, you pay interest. But if you invest the money, they get the return in the shape of dividend. What is the dividend? Second, the share value can go up, they can earn double. Okay. Then second type of shares is the ordinary shares. Ordinary have a voting right and no fixed dividend. Their dividend can be vary, some years high, some years low. And they can give the vote to select the management. CEO of the company, director of the company, they have an AGM, annual general meeting, like PLC, public limited company. We discuss in lesson 1 a bit. Okay, any questions? Some can be convertible, chain one to others, and these, different types of shares. Second, we said Unilever. Unilever used to call Lever Brothers. Share price. Huh? So if you do a bit research, so you can find it. What is Unilever? So that's the share price of 3964 pence. Yeah. So that's the share price of per share. So it's quite huge. The price is quite high. Share price of Unilever. Any question? We okay? Yes. Aniva, can you hear me?
Yes, it's all clear. Yes.
Okay, good. So hope you found as well, and that's the way we can do a bit research. Okay, so as we said earlier, leasing is becoming very a lot of companies in different part of the world, like Askari Bank in Pakistan and Habib Bank, and we have here Barclay Bank, various other private banks as well as the government owned, they offer the lease. Leases mean there are two types, can be finance lease and operating lease. Finance lease, the day first asset will be your name. Like if you had the finance lease on the car, so the logbook of the car, the document will be on your name. And if anything happen with the car, it's your loss. If the price of the car go up, it's your benefit. All the risk and reward you pay bear, and but the just paying lump sum amount. But if it's an operating lease, it's like a rent, you're using it after 12,000 mile and so on. So business carry on getting asset immediate, and payment can be spread over the period of time and can be expensive. Lease, the asset is belong to the finance company, depends on the types of the lease we have. If you have any question leasing, you can ask. So hire purchase, it's like it's like a borrowing. Yes, obtain asset without need to pay a large lump sum amount. You're paying initial deposits. Yes, regular payment. The main difference between the purchase and the lease is what is a hire purchase, repaid all and made the business own the asset. Yes, if you make the payments and after payments, it can be you can own the assets. Okay, when the repayments made, the business will be on the asset, and this is the expensive method. It's because of the interest involved. Okay, mortgage, of course, the loan is secured against the properties. If you don't pay it, asset, and a lot of people says my house, until you not paid off the mortgage fully, it's not own house. If you paid 50% house, your 50% owned by bank. So their interest rate can be fixed mortgage, variable mortgage, tracker, different packages. So mortgage price go up, like your payments when the base rate will go up. Or you can fix in the UK, normally 2 to 3 years, you can maximum fix it, or 5 years, some bank with extra fees you paid. So if the interest rate will go up, even you're not affected. Okay, then trade credit, if you want to buy now and pay later, like we have a DFS sofas, and you can buy now but you can pay later, like various part of the world you carry on buy asset and they will come and pay you, and you carry on making the payments. It can be discount given to the cash payment would be the loss sometime, because if you're paying the cash, you can get discount, you can negotiate, you have a so that's why the cash is known as it's a lifeblood for any business. Okay, government grant in the UK and other part of the world, government grant to the businesses. They sometimes it can be without interest, the grant to encourage the innovation, research and development. Yes, which ultimately government enhance, the employment opportunities, and certain condition may be applied and location where the grant is available. Venture capital is the pooling of the capital into the form of limited companies. They come and they venture the capital and opportunity, the fast growing businesses, and may also buy out the firm administrations, and then they're going to be own it, and then they carry on investing, and various pool can be of investment. Okay, factor affecting the choice, they always look the purpose, what purpose you want money, look around the time, how long you required, in group we can do this activity, but of course at the moment you're doing yourself, but you can think about later on and add some examples. So we included here like medium size engineers from annual turnover, they have they are looking to buy the machines and they want to be invest, and we can look around, we can appraise it, which one is the best option. uh, all the financial needs of the business can be grouped the following categories. You look the type, the times, the long, how long you want, short term, long term, medium term, and what purpose of your loans, because don't borrow money otherwise it's cost you. Okay, sometime we can, the number of ways right, raising finances which we can look around, and that's which we need to carry on doing it. So that's okay. Then we can look around next, are the key areas. Internal source of finance. Internal mean within the company or your own, because you have a previous year profit, you retain it, you not give to the shareholder. That you can sell different asset and you can raise money, like you can sold building, you can raise cash, your machinery, debt collection, maybe customer owe you and you can sell your debt and you can get the money from the bank and directly get from the customer. These are different. Okay, so a task in pairs, of course, we're not doing in the here in the class is the online. One person joined today, but we can look around these and we can do the activities. It can be own investment. What are the advantages, disadvantages, return profit, the previous year, that's the internal source, sale of stock, sale of asset, and collection of the debt. Each the source, and we can look around, each is a different source of finance. Owner investment, which is mean you investing your own money into the capital, like if it's a sole trader, it's a partnership, so it means all the risk and reward goes to you. If the business earn more profit, it's yours. If business be at the loss, it's yours. So that's which we need to, doesn't have to repay, no interest is payable. Disadvantage, there is a limited to amount an owner can invest. Okay, saving another net eggs. Yes, all the entrepreneurial will be often, invest in the personal cash balance into the start. And this is the cheap form of finance, and it is readily available, and investing, the personal saving, maximizing the control, entrepreneurial keep the business is also strong signal of commitment, outside investor and provide, and remortgage can be. And these are all the way we can finance it. Entrepreneurial take the second largest mortgage on the property, and then they can raise the money, yeah? So maybe you can borrow more money, and then it can be low cost finance. Through risk can be, because maybe if you can't afford it, your house can be occupied by the bank. Okay, borrow from the friend and family. Okay, that's why it's really good relationship with your grandparent can be, if they have a lot of saving, pensioner, retired sometime, and so the kids can borrow money from the grandparent, and when they get the work and they carry on paying them back. It has the cultural wise, but in different parts, if you give them money, they did not pay you back as well. So we need to look around. Thus is no interest involved, it's a cheaper source. Okay, credit card, the other source of finance, as we know, the banks issue the credit card. Credit card normally is a high interest rate, like it can be 30-40%. In some part of the world, it can be prepaid, but it's normally credit card mean, you're getting credit for the certain period of time and you have a limit on. Okay, as we said earlier, return profit, it's the previous year profit you're returning. So these a bit, the repetition of the thing. So please, we can relook it. A sale of stock, we have its own advantage. That's a less costly process, internal source of finance. So internal source of sales are fixed asset. We can, if it's a property, plant, building, equipment, you can sold it, you can raise money. Ultimately it's help you, because if you have a spare asset you're not using it, what's the point? Okay, and that's we can use it to expand our business. Okay, then debt collection. Yes, if you the customer owe the money and is about to collect from the debtors. Debtors mean your credit customer, you sold them and they not paid you, and it's no interest involved. And sometime, but customer can be frustrated if you can, trust can be break, and that can be disadvantage. Factor affecting the sources of an purchase as we said earlier, purpose, time, period, amount, ownership, and size. In pairs, we can look around which is the internal and external source of finance in these cases. So please look the internal and external we discuss at the top and then answer the questions. Okay, then 3.3, we can look around different investment appraisal. When business spend money on the new asset, it's called capital investment or capital expenditure, and normally irregular large amount is required, and we have to appraise it, where you can, and we can look around different appraisal method. So what is appraisal? Appraisal means checking the performance, and appraisal help to look around and we can appraise. So appraisal always when you do in time, in cost, and quality. Always look, because that will help you. Okay, so payback. One of the investment appraisal method is a payback. Payback means when you borrow money, how long will it takes you to pay money back? It's a easy to calculate, easy to understand, and can, but it's not calculating. It's only we calculate if you £100 you invest, how long will take you £100 you get back. That's if it's a 1 year, so 1 year payback, 2 years payback, 3 years payback. If you're investing money on education, we can say, you spend £20,000, so 20,000, how long will cover you? And then of course, benefit can be forever. So we're not calculating the benefit forever. We only looking what you invest, what you get back. And this is the disadvantage of, don't consider the time value of money. Yes, not considering the profitability, not considering. Okay, so one method of investment appraisal is a payback. So like, so we can look around here, please. If you look here, we're saying years, 1, 2, 3, 4, 5. We have a payback. So we can say you're investing £3,100 in the business. You're getting £1,000 back, £900 back, £800 back in year 3, year 4, year 5. So 3,100, if you're getting 1,000, so 2,100 is outstanding. After 2 years, 1,200 is outstanding. After 3 years is 800, 400 outstanding. So we can say, so you basically you're looking 1,200 minus 800, 400 remaining. So 400 is remaining, 500 you're getting in. So we can say this project will take 3 years. End of 3 years, you have 400 still outstanding. So 400 divided by 500 times by 12 months in a year. Outstanding amount divided by the following year inflow. And we can say this project will take 3 years and 10 months. Always shorter is the better. Yes, if you have a different. Any question here? If you have, please, you can ask. If you not get any points from this, this is one of investment appraisal method, which is called payback. Payback mean what you invest, how long will take you to cover the money what you invest. And always shorter. If we have other option to invest in project B, project C, so if they give 4 years, 5 years, so we'll go for 3 years. Okay. Then discounted payback, the word as a discounted, if you have a £10 today is more worth it, the £10 you will get back in the future years. So time value of money, the value of money will drop, so we'll depreciate the value of money in term of, we're not looking in term of foreign currency, but we're looking in the real world, the value of money drops. So that's, we call NPV, net present value, take in account of the money at the time value. We can look around the NPV takes, the future today term, and we forecast the return are discounted to find out the present value. Investment should be ahead if the present value of the return is higher than the cost. That's, which we need to look around. Consider the time value of money, take into account of both timing and the amount of the cash. More difficult to calculate and understand than other method, and that the choice of the discount rate is arbitrary. So next we're looking the time value of money. Okay, so we are looking is NPV. What is the NPV stand? Net present value. What is NPV? Is the net present value. If NPV come positive, we accept the project. If NPV come negative, NPV positive, yes, plus positive, accept. If it's come your NPV negative, you reject it. Okay. So what we need to PV factor, PV is called discount factor. So if it's cost you, let's say, we said base rate is a 4.5%. At the moment, inflation is around 10%. So what you can do, you can look around discount factor 15%, or you can look around this factor 10%. So if you're looking the discount factor 10%, so you can look around 1 divided, formula is 1 plus 1 divided by 1 plus R. Okay, R is look around the discount factor. So what is a 1? 1 mean 1 pound. 10%, can we write it 0.1? Yes. So if you do 1 divided by 1.1, can you divide it please? On the calculator if you have. Moniba, yes, if you divide 1 divided by 1.1, you will get down 0.9.
1 yes.
Yes. So whatever answers you will get, if you carry on dividing by 1.1, like you got in year 1, it means 1 pound value after 1 year will be only 90 pence approximate. Yes. If you carry on whatever answer will come, you carry on dividing 1.1, and double year 2 will be 0.826 around. Yes. And year 3 will be 0.7. So it means in year 3, 1 pound value will be 0.75 pence. So that's, if you're getting 5,000, so you are investing 20,000, that's the money went out. We are getting money in as a return 5,000. If you're getting 5,000, the real value of 5,000 times by 0.909, real value will be 4,545. Then year 2, if you're getting 7,000 times by 82 pence approximate value will left. So that will be the value. You're saying I'm getting 7,000. Actually, you're not getting 7,000. The value of it is, in your hand is a 7,000, but actually the real value of it is 5,782. So that's, the discussion happening in different part of the world, like foreign currency, then inflation, you becoming poor and poor day by day, and we becoming poor and poor because, due to the value of the money. Yes, because money not making the things and our standard of life is dropping. So that's we appraising. So if you add all these figures, yes, 4, 5, 4, 5, 5, 7, 8, 2, and 6. If you add them all and take out 20 out of it, our figures is coming negative. So we not accepting the project. Yes, NPV is a negative. If it's come positive, your positive figures are higher than the negative, that mean outflows, then you accept it. Yes, otherwise we not accept it. Okay. But that's, and then we have a ARR. ARR is known as annual rate of return. The formula is average profit divided by initial investment and time. So we're looking higher return, always better. Okay, so we look in this example, we have 3 projects, A, B, C, or we can say Handover, Bristol, and Carlisle. We're investing 4,000, 4 million, 4 million, and 5 million. And how much profit we are getting, how much inflows, money coming in, 1 million, 1 million, 1 million, 1 million, 1 million each year. So we are getting 5 million. We invested 4 million. 5 minus 4, 1 million is your profit. 1 million profit we are getting in how many years? In 5 years. You divide on 5, so we'll get 0.2. And if you do average profit is 0.2 divided by 4 times by 100, so we getting 5% profit. Yes, and exactly the same way we getting 0.2. It's the same percentage because we're investing 4, but in the year 1 we're getting 1.5, year 2 we're getting 2.5, 0.5 million, 0. And in year 5 we're not getting any inflows, money not coming in. So that's we add them all. It's a 5 minus 4 is 1 divided by 5. So you're getting 0.2. 0.2 divided by 4 times by 100. So we getting 5%. If we choose the project C, so we getting 0.5, 1.5, 2, 3, and we add them all and positive figures. Yes, and we minus This 7 minus 5 equal to 2 million. We're getting profit. What is the average? We're getting 2 million in 5 years. So 0.4 divided by 5 times by 100. So 8%. So we, based on our the percentage, we can say project C is the better than, which give the average higher rate of return compared to handover. If we don't have a 5 million to invest, so we can go for 4 million, and between A and B, we'll pick B because even we have a same return, but they are getting quicker cash flows in the years first and the remaining years less. Any question? You okay? Yes, so that's, which we can look around. Then explain the possible drawback of the balance sheet. Of the balance sheet, some item you don't want to show in accounting practices is illegal, and debt to equity ratios, which we want to be sure, and the financial statement need to be true and fair, as we discussed in the previous lesson. And accounting rules we have to follow to make, our product more and to investing. Of the balance sheet, financing is the practice where the companies keep, certain asset and liability reported on the balance sheet, and they try to be off, the debt to equity and the liquidity ratio, it can be affect. And we've been given the links, please, for extra reading, which we can click and we can read extra. Of the balance sheet, it's not showing on the balance sheet. Balance sheet is a statement of financial position, also known as the balance sheet, which shows asset, liabilities, and capital of the company, and it's illegal to show the off the balance sheet. And then I included some link for extra reading, please. You can look around, and which you can. And next lesson will do our, the next, our area of discussion. Any question, Eva? That's all today, which we discuss sources of finance, internal, external, short-term, long-term, medium-term, and we discuss investment appraisal, payback period. Always shorter is a better. NPV, net present value, if it's a positive, accept, and ARR, higher is a better. That's all was our discussion. To summarize it, and hope will speak you during our next lesson. Thank you.